Buenos dias, good morning. How's everybody? Anybody have a hangover? No? Okay, great. Well, my name is Paul Maggio, and I'm one of the luckiest people around. I've been in an industry that has grown 20% since the start of financial futures in 1972. There's always been something interesting to wake up for in the morning in our business. I work for a company called NewEdge, and besides being one of the leading global brokers, our company has been a leader in research and education for our clients in the pricing of derivatives, basically futures and options. Outside the financial world, futures are a misunderstood instrument that's most associated with gambling, but futures have played a very important role in the growth and maturity of the financial markets. These products have enhanced liquidity, reduced transactions cost, increased transparency, and made the capital markets more efficient. Rather than gambling, futures exist to transfer risk so people can better operate their businesses. This instrument called futures started a revolution and transformed the world of finance. With trading futures at NewEdge, we have no conflict of interest with our clients. We trade the broad market on behalf of them, and we don't care if they buy or sell, we just facilitate the trade on their behalf into the central marketplace, not as a market maker, but as their agent. So this model of world-class research and best execution has helped our business grow with the industry. Especially in light of the new regulations coming from Dodd-Frank, this should help our business. So our clients are basically banks, security dealers, insurance companies, pension funds, institutional investors, also CTAs, commodity trading advisors, or managed futures. So here's what we're going to look at today. We're going to go over research and value in futures from the 70s, the innovations we had in the 1970s, structural changes in the 1980s, the maturation of the market and new players coming into the market in the 90s, and then today, what are we doing today? So this is a relatively young group, so I'm going to take you through a walk through our industry's colorful history and the explosive growth since the beginning of financial futures to the present. We'll see how research played an important role in the growth of the capital markets. So this is a chart of the growth of our industry from 1955 to the present. Before 1972, there were only agricultural and metal commodity markets that were trading. They had some good growth from 1955 to 1972. In 1955, the industry traded 4 million contracts a year. In 1972, they traded 18 million contracts. They grew at about 10% per annum. I mean, any business would be proud of that growth. But if you look here, it's completely overwhelmed by the growth of the financial futures markets. It doesn't even register down here. I started working in the industry in 1985. That's when the business took off. So I'll take some credit for that growth that we saw. I mean, actually, you could have been a monkey or fallen on your face and still did pretty well in this, with all this growth we saw. So our industry met the needs of increasing risk in the world and globalization in finance. Both of these factors, risk and globalization, were the catalyst of change that brought about the revolution. So in 2011, at the peak of our volume, we did 25 billion contracts. So if you just look at these milestones, 1972, currency futures were introduced. 73, options began trading at the Chicago Board of Options Exchange. In 1975, the Commodity Futures Trading Commission regulates the markets. 77, bond futures. In 1982, international futures began. And then I began my career in 85. So you look at this chart, and even though financial futures were introduced in the 70s and the 80s, the capital markets didn't experience the rapid growth until the 90s. Why did it take 20 years to mature. Well, we have to go back in time into the 70s to an obscure futures contract called plywood futures. I mean, what does plywood have to do with anything? Well, there was a young economist from the University of California, Berkeley, named Dr. Richard Sandor. And he helped develop this plywood contract where hedgers could come together and price their risk, reduce the risk of their manufacturing and their use of plywood. This contract taught him how to create, develop, and promote new futures contracts. The Chicago Board of Trade hired him as chief economist in 1972. In 1972, inflation was out of control in the United States. Food, grain prices exploded. And the government talked about putting price controls on the marketplace. Well, they wanted an agency to regulate this. So in 1972, the Chicago Board of Trade helped draft a law for the CFTC, the Commodity Futures Trading Commission, to regulate the markets. Richard Sandor, the Board of Trade lawyers, Senator Herman Talmadge from Georgia, who was head of the Agricultural Committee, really changed the industry forever. They were able to insert the words tangible and intangible into a bill that gave a broad definition to futures contracts. The bill gave the rights and interests to be regulated by the Commodity Futures Trading Commission, and it was signed into law. This opened the door for financial futures as we know them today. This excluded the SEC, the Securities Exchange Commission, from regulating these new markets. And during that time, the SEC had a stronghold on the financial markets. So this law provided the new agency would have exclusive jurisdiction and meant that no other agency like the SEC could interfere with the exchange-traded markets. And now the CFTC is becoming the most important regulator in the U.S. Because of Dodd-Frank and moving the OTC markets to the exchanges. So in 1972, Dr. Richard Sandor, the same man, wrote the first interest rate contract on Ginnie Mae's, the Government National Mortgage Association, a bundle of those bonds, which created the path for other financial futures to begin. Today he's known as the father of financial futures. So Richard said, for the market to begin, the first thing that has to happen is you need a structural change, a catalyst. So in 1970, it was inflation. So Sanders said you need 4 elements to begin the markets. The first is legislative. You have to have legislation that clearly defines the commodity you're going to trade. You need legal expertise, and you need accounting expertise. Number 2 is regulation. It has to be fair, and the regulators have to understand these products. Number 3 is you have to build the institution and collateralize it, basically the exchanges. And number 4, you have to design the futures contract. This was a place at the Chicago Mercantile Exchange and the Chicago Board of Trade. So after steps 1, 2, 3, and 4, it comes to number 5, sometimes the hardest one. You need to build participation in these markets. The participants need education, and the markets themselves need promotion. Richard Sandor, the father of financial futures, said, markets are created and nurtured, not born into success. So futures is an institutional business. The successful firms like NewEdge have bridged the gap from what we are brokers for and how our clients use these markets. Discount Corporation of New York Futures, Dean Witter, Indo-Suez Car Futures Callion, and what is now NewEdge, always started the work of research with questions like, is this market rich? Is it cheap? Is it fairly priced? How can we hedge the risk and create a synthetic asset in this market? And how can we help clients exploit mispricings? I have to give a lot of credit to our head of research, Dr. Galen Burkhart at NewEdge. He's first an academic and always held his research out to the public domain. With the vision of Galen, we created within our firm one of the first futures and options schools. After the success of our futures and options school, Galen and his colleague, Morton Lane, were asked by the University of Chicago to deliver the same curriculum to U of C MBA students. At University of Chicago program was a semester long. but our class was delivered in a much shorter time, 4 days. The idea was to educate and help clients, give them tools we have developed, and show them how to use them. This program was taught by our senior level professionals and has educated over 8,000 participants from the world's largest banks, government agencies, corporations, and investment institutions. Also, more than 600 graduate students attended Galen's class at University of Chicago MBA program. So as you'll see, our books and research pieces have stood the test of time. These books are in probably their 4th or 5th edition now and are considered the gold standard in our industry. Galen has been an ambassador for the use of futures markets and has traveled extensively around the world to educate people in the use of derivatives. These are 3 of Galen's books, and I'll plug Galen a little bit. You can buy these on Amazon.com. So our research is focused on a few things. One is embedded options in contracts, bond futures, Eurodollar futures, commodities, swaps, liquidity estimations, and CTA, commodity trading advisors, in an investment portfolio. So now I want to tell you about the contributions our research has provided over the past 30 years. So in the 70s, Chicago was considered a second city. We had an inferiority complex versus New York. We were always trying to beat them. We got the name the Windy City because our politicians would brag and create a lot of wind. But our commodity exchanges were starting to bring about change. We had institutions like the Chicago Board of Trade that is 165 years old. Chicago historically has had some crazy commodity markets where men in colorful jackets stood in trading pits, yelled and screamed, trading butter, eggs, pork bellies, and grains. New York had the securities industry with the New York Stock Exchange out in front. We Chicagoans wanted to compete with them. So with the advent of Treasury bill futures in 1976 and Treasury bond futures in 77, it brought 3 of the 36 New York primary dealers to Chicago to trade the contract. Discount Corporation of New York being the first one. In New York, these primary dealers controlled everything. They would set the bid and offers, and all the government offerings had to go through them. The futures market started to democratize these markets as anyone with an account could have access to Treasury futures. The 3 primary dealers that came first had a huge advantage over the other ones because they were using T-bill and Treasury futures. These dealers were able to arbitrage the difference between the term rate and forward rates of T-bill paper and T-bill futures. Once other dealers saw what these 3 dealers could do, they opened accounts and came to Chicago. After Treasury futures took hold, bid offers and Treasury bonds tightened dramatically. Before Treasury futures, the market had a bid offer of 8/30 seconds for on-the-run Treasuries. After the futures came, the bid offer collapsed to 1/32 second. I mean, this slide says it all. With the democratization of the Treasury market, new players could come in and compete against these primary dealers that had a monopoly on the Treasury market. Bond, stock index, and bank deposits were born, and the democratization of the markets began. Can I play in your sandbox? Chicago finally started muscling in on New York. In the securities business in 1973, the Chicago Board of Options Exchange, an offshoot of the Board of Trade, started trading options on individual stocks. So let's move to the 80s. I was thinking about all the changes in our industry, and I saw that this was happening in other parts of our world too. Michael Jackson was changing the music industry, much like the futures would change the financial world. And the Chicago exchanges were fighting for respect, just like Rocky. The 80s were a real time of innovation. There were no computational finance programs in any universities, and there weren't even really any business school programs that dealt with futures and options. In 1980, financial futures started and the research followed. Only a book on Black-Scholes model really existed there for reference. All the heavy-duty work on option pricing was being done inside firms like Freddie Mac, Solomon Brothers, Discount Corporation in New York, and later Dean Witter, Car Futures, Callion, and now NewEdge. Most option research was focused on stock options, which were traded at the Chicago Board of Options Exchange. So before the 70s, banks accepted short-term deposits at low regulated rates and then offered business and personal loans at a higher rate. This old banking model was turned upside down because of inflation and deregulation. Treasury futures started in 1977. In 81, they were being active. Fed Chairman Paul Volcker's war on inflation made many people aware of interest rate risk. Inflation forced cash out of the regulated deposit markets, which led to a creation of an active, unregulated money market that competed for cash. Also, the steep inversion of the yield curve forced banks to look at yield curve risk. New ways to manage risk were born, and the questions became, for the banks, use these tools or go out of business. And many firms, like some savings and loans that could not adapt, did go out of business. We also found applications for Treasury futures from other areas of finance. The work that was being done in pricing the prepayment option embedded in conventional mortgages in the U.S. was amazing. It helped us price the delivery and timing options that are embedded in Treasury futures. So Galen co-authored a book with Terry Belton from J.P. Morgan called The Treasury Bond Basis, which is still a classic read on the details of hedging and trading Treasury bond futures versus cash. One of the inspirations for understanding this work was from the optionality in the mortgage market and callable bond market. In the mortgage market, the bonds have a prepayment option, so if rates fall lower, the mortgage or bond can be called away. Then the issuer can finance at a lower rate. The optionality in the mortgage market gave us clues that there were embedded options that are in the Treasury futures contract, and there are arbitrage opportunities for participants that understand how to price these options. In the books, the authors go into futures and how the bond basis works. So the bond basis is the difference between the cash bond price and the converted Treasury futures price. And these bond contracts are a basket of similar duration bonds. So please recall that this bond futures contract behaves as an index. So it might not exactly track the underlying bond you're hedging. So you have basis risk, which is the difference between the bond you are hedging and the futures contract. So in the Treasury futures contract, the short owns the right to deliver whatever bond in the basket he or she chooses at whatever time during the delivery cycle. So hopefully this is the most algebra you're going to see in this presentation. Remember, futures are not an asset. An asset is a stock of wealth that has price exposure, like these commodities down here. So with futures, we can create a long synthetic asset by having a deposit, a cash deposit, and then we add the futures contract on top of that to give us the price exposure. The futures contract only gives price exposure. So if we do a little algebra here, a long asset minus a futures contract equals a deposit or lending, or a short asset plus a futures contract equals borrowing. From this equation, a long asset minus a futures contract equals a deposit. We saw that Treasury bond basis yield less than a deposit. It should yield a deposit, but it yielded less than a deposit because there are options embedded in this short futures contract. The two options are which security in the basket you're going to deliver and when you're going to deliver it. So because you're long this option or right, you have to pay for it, which reduces the return on your deposit. Remember when the mortgage market helped us understand these? The option in the mortgage market is to call away the bond. The option in the futures market is to switch the bond or change the time of delivery. The short will want to deliver whatever bond is least expensive to deliver. So in the mid-'80s, bond futures were seriously underpriced by 200 to 300 basis points on a Treasury portfolio. The dealers made money by being short bonds and long futures or short the basis. This embedded option there was way overpriced, and they were able to capture being short that option. In the 90s, Bund futures in Germany were way underpriced. It was the only way that you could short German government bonds was by selling futures contracts. So this made this contract cheap. If you spent the time to understand how to do this, you could outperform just by buying the Bund futures contract rather than buying the cash bond market. So here is some of the analytics we produce daily. These are on all the basket of the 2 years, 5 years, 10 years, and 30 years. We do all the estimations on it, and we give the probability of it being cheapest to deliver here. So, has anyone ever heard of Chicago Research and Trading, or CRT? Okay, well, CRT was a Chicago firm. In the 70s, they started trading options, basically with a handheld HP calculator. They were one of the first to use technology in the pits, which by today's standards is pretty primitive. They became a large market maker in the option market and developed a sophisticated risk management system. They were very big bond option traders. CRT was bought by Nations Bank in 1993, and Nations Bank moved its headquarters to Chicago. In 1988, it merged with Bank of America. They're still a huge bond trader. The CRT risk management system still exists within Bank of America. In 2008, what hurt Bank of America was not their bond portfolio, it was their buying of Merrill Lynch and Countrywide. So again, in the 80s, the Eurodollar futures contract was revolutionary because it, along with CATS, which are the Solomon Brothers acronym for zero coupon bonds, stripped from treasury bonds, made zero coupon bonds a reality. It created many building blocks from which any interest-bearing instrument could be priced or hedged. Financial engineers could value bonds separately and consistently. So the Eurodollar futures contracts are the exchange-traded equivalent of forward borrowing and lending rates. Eurodollar futures provide two things. A Eurodollar futures contract price, when subtracted from 100, provides an indication of what the forward rate is for that period covered by that particular contract. And number two, the Eurodollar futures contract is a tool for locking in synthetically a forward borrowing or lending rate. The Eurodollar is a private credit market or banking credit for dollar-denominated transactions. It's perhaps the most liquid short-term dollar market. It, with LIBOR and their options together, are without a doubt the most liquid and active money market traded derivative. So this futures contract is cash settled, where no commodity is exchanged between buyers and sellers at expiration. Only the cash difference is exchanged. This concept was revolutionary at the time and ushered in stock index futures. This insight allowed the market to focus on price or interest rate risk, and hedging and speculating costs dropped dramatically. The market developed interest rate derivatives, swaps, forward rate agreements, and futures on banking deposits and government bonds. Eurodollars are used as the building blocks of the swap cash market curve. So investors today are breaking up the yield curve in all kinds of segments. The result is a mix and match world of where borrowers and lenders can have about any kind of asset liability that they want. One remark from a head of an asset liability trader at a major bank has stuck with me is this. He said the reason he loved Eurodollar futures contract was because of its offset feature. In the cash market, if he tried to manage his interest rate risk actively, he would end up with all these trading lines full and no room to maneuver. In Eurodollar futures, he could buy in the morning, sell in the afternoon, and be flat and have plenty of room to work. So let's move on to the 90s. We saw a lot of changes. I mean, I don't know what Michael Jackson was thinking, but anyway, he was changing color before our eyes, much like derivatives-based and other currencies. And the European action heroes were growing in popularity, much like the foreign futures exchanges that were growing rapidly. The Berlin Wall had just fell and globalization was taking hold. In the United Kingdom, France, Germany, and Japan had just started futures exchanges, and there was opening up new products all along their yield curves. By the mid-90s, futures markets began to mature. Most of U.S. business schools were offering derivative courses. U.S. banks and dealers were active in bond and eurodollar futures markets. The interconnection of the U.S. markets happened, but overseas, the futures began to catch on like wildfire in non-dollar markets. We were witnessing the complete interconnectedness of the world banking and treasury markets and its integration globally. So one piece in the 90s that was big was the convexity bias research on eurodollar futures by Galen Burkhardt and Bill Hoskins. It was really important on pricing derivatives. This all seems like ancient history, but until that time, futures has been treated like forwards. Swaps were priced directly from futures rates. So if you could receive a fixed rate on a swap and hedge the position with eurodollar futures by selling the futures, you could make a lot of money. Galen and Bill's findings found that the convexity difference between eurodollar futures and 5 and 10-year swaps could be worth 5 or 6 basis points was revolutionary and completely changed the pricing relationship between these two markets. So convexity in eurodollars was one area of research in the 90s that's still relevant today. Because eurodollars are used to hedge interest rate swaps and any additional cash returns, you have two different instruments that do the same thing but have different characteristics. Eurodollars always and everywhere have a minimum price movement of $25. So this price is linear. Swaps, on the other hand, have the characteristic of a bond, so its price is convexed or curved. When interest rates fall, the price of the bond increases more than when interest rates rise. It's not one-to-one. So when you're hedging using a short eurodollar futures position against your swap, the position will give you an advantage. When rates fall, your swap will outperform the eurodollar. When rates rise, the eurodollar will outperform the swap. Basically, in options terms, this will act like a long straddle. So our research helped traders correct this mispricing in the marketplace, and the market knew it existed, but our research really quantified it. From this research, our clients added value without taking any more risk. So if you look at this, there's a lot of detail on this slide, but what I want you to look at are these lines here. One is the futures string, and one is the cash swap market. As you can see, there's a difference between the two. This is with no convexity taken into account, and that's with convexity taken into account. You see, it's a much better hedge, and they track each other much, much closer. So the book you saw earlier, the Eurodollar Futures and Options and Handbook, is Galen and NewEdge's contribution to the market to understand this contract. So in the 90s, we saw many stock index futures listed globally. Here's a list of all the major futures stock exchange markets now that trade indexes. George Panos from our research team, one of our best teachers, was doing some equity work. He did a piece called Opportunities on the S&P 500 Calendar Roll. So before the markets were completely mature, the global stock index futures had mispricings that we were able to help our clients take advantage of and more efficiently help them roll their position from one contract month to the next. So here's a slide some of you may be familiar with. When you have money, you can buy an asset, or you can buy a deposit and buy the fairly priced futures contract. Either way, you reap the same return. It's the same. When you don't have money, you can sell a deposit or borrow money and buy the asset, or you can buy the fairly priced futures contract. Either way, you reap the return of owning the finance index. We call this a positive carry market. Income from the dividend is greater than the cost of finance. Historically, for stock index futures, this isn't the case. It's usually negative, but because of the Fed's zero interest rate policy, this has changed the way this market is priced. So we can create a synthetic asset by investing the cash in a deposit rate of 2, and we have it throws off a dividend of 4, and we can buy the futures contract at a forward rate of 98. Again, we see the positive carry. So our basis is the spot and the price of the futures market, which equals carry. So one thing that some traders are doing is what's called a portable alpha strategy. You can take more risk either through duration or through credit. The risk-free market rate was 2. That's what the market uses to price this contract. But now we can invest in 3. This moves the futures value or the forward price higher. In this example, the higher interest rate you earn on the cash is depicted as a difference between the market price and the effective price. Fair value says the market should be 99. This is our effective price, but the futures market price is 98. Futures are cheap, okay? But remember, there's no free lunch, and as they say in Latin America, there's no maná. So when you take more risk, it may not be free here. If you can get a good estimation on dividends and the funding rate, you can price the value of stock index futures. All the research covered by Wall Street gives a pretty good estimation of U.S. dividends. In other places, it's harder. If you look at this slide, this is the S&P 500. And if you look at it, the dividends are pretty consistent and pretty well known. And Wall Street does a good job of getting that out there. We look at other stock indexes. This is the Euro stock index. And it's consistent, but it's seasonal. It looks like it's paid in certain parts of the year every time. And then we go to a place like Mexico, the Mexpol index. And the dividends are random. I mean, this is a hard one to price because the dividends don't come out so consistently. So NewEdge still publishes regular equity roll reports that show the richness and cheapness of the indexes relative to LIBOR. So has anyone ever heard of O'Connor and Associates? Okay, well, O'Connor and Associates, another Chicago company, was started in the 70s. And it made markets in stock index options, traded on the Chicago Board of Options Exchange. After much success in Chicago, they went global with their market making. In the late 80s and early 90s, in Japan and during the Japanese equity bubble, their smart traders took advantage of the arbitrage in the Nikkei. They were able to buy the Nikkei 225 and sell the futures at a premium. Also in Japan, life insurance companies held only fixed income, but they wanted equity returns and exposure. They wanted to get rich like everyone else was doing, being long the Nikkei. So to increase the rate of return they were earning, the insurance companies were buying notes that had embedded short put options on the Nikkei. They didn't completely understand why the return was higher, or they thought the Nikkei was going to go up forever. O'Connor was able to price this and hedge the embedded options in these bonds. As we know, it didn't work out so well for the Japanese insurance companies. O'Connor was bought by Swiss Bank Corp in 1992, and then the Swiss government merged it with UBS because UBS was having financial problems with the long-term capital problems in 98. UBS kept the equity people from O'Connor, and it did well. UBS got rid of the bond people, which was their portfolio that hurt UBS in the 2008 U.S. housing bubble. So let's move on to the new millennium here. Michael Jackson went away. His music still lives, but just like the Fed's zero interest rate policy and the bond buying program by the Fed made the embedded options in Treasury futures figuratively go away. But they're still there, and they may come back with some recent bond market volatility. And like old action heroes from the movie The Expendables, the world's futures exchanges have been awakened by electronic trading and the new too-big-to-fail banking laws that are pushing OTC business to the exchanges. So where we are now is the latest revolution in finance, electronic trading. Highly sophisticated traders are spending a lot of IQ to gain speed at the exchanges. co-locating their servers at the exchange. Before there was electronic trading and high-frequency trading, there were pits and open outcry. We called these market makers floor traders or scalpers. They were in the pits, and their goal was to buy the bid and sell the offer as many times as they could and collect the bid-offer spread all day long. They were the high-frequency traders of old. Today, the E-mini S&P futures contract trades around 2 million contracts a day. The average size trade is 3 contracts. So imagine the volume and this average size trade in the old pit traded days. These 700,000 transactions a day would be humanly impossible to handle. So now it's commonplace for our market to price closer to fair value. We have deep, liquid, mature markets in the U.S. And our latest research has been done on the market's microstructure. It's called Measuring Market Impact and Liquidity. Now that the markets are highly efficient and liquid, we're helping our clients reduce the cost of trading in the marketplace. Commissions are the smallest cost, but the easiest to see. But the real cost in the marketplace is market impact or slippage that they experience in the market. It's the bid-offer spread. So we produce tools by capturing the book that the exchange publishes every time it changes. And because of storage space now in our new world, we can capture every time the order book at the exchange changes. And what we do is we store all this data, and then we run our analytics to show clients when the best time to enter into the marketplace is, when's most liquid, when it's the best time that won't cost a bunch of money for them. So basically, our research helps clients reduce execution cost or estimate what this will be. And we produce this report every day for all the major markets. Some of our research tried to understand the high-frequency trader or the market maker. As you see from this slide, we modeled the function the market maker provides. Again, he's trying to get the edge. He's trying to buy the bid and sell the offer as much as he can. If there's a perceived risk, he's going to charge more via a wider bid-offer spread. If there's less perceived risk, he will charge less. So through our research, we discovered there are 2 variables that one should focus on determining how much the bid offer is going to change when we trade and what that's going to cost. The 2 things that matter most are volatility dictates the bid offer spread for the volume that's being traded. And number 2, a ratio, my volume versus the market volume. So if you see from this chart, this is probably very intuitive for everybody, but this is the S&P 500 mini contract. And we normalize volatility here. The red line is volatility. So as volatility spikes, the cost of us to do, in this case, it's an $82 million trade in the marketplace, 1,000 E-mini S&P contracts. It costs us, when it's low volatility, $10 to $15. When volatility spikes up, it can be $40 per contract. So this shows that, kind of the function of the market maker. Volatility, and the more volatile, the more slippage it's going to cost you. Here's another contract, the COMEX copper contract. This is showing, again, the same chart, but at a much more illiquid contract. This is $8 million per trade, 10 contracts, and volatility is costing, when volatility is high, $60 to $80 a contract, and with volatility dropping down, it'll go down to 20. So I'm going to quote Dr. Richard Sandor again when he said, "New York is the investment banking capital of the U.S., San Francisco is the technology capital, but Chicago is the risk and trading capital." There are some of the largest high-frequency trading firms based in Chicago you never heard of. The major players in the capital markets. These participants based in Chicago sometimes trade over 40% of the Bund futures on the Eurex exchange and other markets outside the US. Some of these firms are DRW, TradeLink, Infinium. Maybe you've heard of GetGo. They're the ones that bought Knight Capital after Knight had a huge loss from high-frequency trading. Another huge player in the marketplace is what The Economist magazine called the largest exchange you never heard of, which is the Chicago Mercantile Exchange, or CME. It's flexing its muscles globally too. The Great Recession of 2008 sped up risk management practices that were slowly taking hold in the financial world. These were always in place at the futures exchanges and served the exchanges well. The ideas of requiring capital to guarantee performance, marking positions to market every day, and settling up gains and losses in cash daily has been a great way for reducing counterparty risk. The Dodd-Frank law, a law that's going to touch all of us in some form or another, it's taking its direction from the exchanges. More and more OTC instruments will be traded at the exchange. So we've lived through the evolution of the markets. In NewEdge's case, our research helped build capital markets. What does the futures market hold for capital markets, and what role will research play? Maybe futures on risk of nature, climate, extremes that are in today's world. These may be catalysts for new products. We'll continue to see the evolution of capital markets in the developing countries. These emerging markets are going through their 4 steps. Their legislation is opening up their countries to the rest of the world. Their lawyers are understanding the contractual obligations. Their accountants are understanding the tax treatment of these products. Their regulators are becoming more sophisticated, and their institutions are being collateralized and established, and contracts are being designed to transfer risk. As the world continues to evolve, we'll see other risks come up, and exchanges hopefully will create products to manage these risks and a place for speculators to take that risk. The markets do a reasonable job of offering the transfer of risk. Research will be close behind to help participants understand how to manage these risks. I've lived through this history of growth in our industry and capital markets and saw how research helped. This is my story. You have a new futures markets here in Colombia. I hope to come back someday and hear one of your stories about the growth of the Colombian markets. So I'll leave you with this, and it has many applications from finance to life, and it was said by some very smart academics. Life is an option. Once you understand options, you see them everywhere. So thank you very much for your attention.